Welcome to Venture Café Presents. I'm Christine Dunn. Joining me today is Maya Heyman. She's the Senior Managing Director and General Partner for Common Angels. Thank you for joining me.
My pleasure. Thanks for having me.
So Maya, Common Angels has restructured a lot in the last few years. Can you talk to us a little bit about what motivated the restructuring and why that happened?
Right, absolutely. For us, we focus on software, internet-enabled businesses, technology companies, mobile, and it's a very competitive space. So what we wanted to do was put the entrepreneur at the center of our focus, and we found that pooling the capital and creating a fund instead of being an angel group was the right way for us to differentiate ourselves and be able to attract the best and brightest entrepreneurs, because we would be easier to interface with, and it was very clear to the entrepreneur that we are a fund and that a fund means money. And so we believed that would resonate and help us attract the best and brightest entrepreneurs. And indeed, we're thrilled with the results and ended up raising a $27 million fund. And yet we've also preserved what's wonderful about angel groups is the connections that angels bring. So our capital comes from leaders in the Boston technology community, and of course we have some leaders in the technology world that are not here in Boston that committed to the fund.
Now, when you decided to change that focus, did you change at what stage you were investing? I mean, angels are usually known for investing in pretty early stages, although recent trends have been that there's been a bit of a funding gap at the very early stages. So, what was the focus there in terms of what stage of growth you're willing to invest?
There actually is not a change. In terms of the investment thesis and the focus, still early stage companies in the technology sector looking for capital to go to market and build scalable, repeatable sales and marketing. So another way to say that is, if you think about venture capital, traditional venture capital firms, they like to fund scaling. We will take that step right before scaling. We will help with the capital to go to market and figure out how to build, as I said, repeatable, scalable sales and marketing. So we're that step before traditional venture capital, and that's been our sweet spot. That's where we've always played, and especially now, given how it's fairly cost effective to build software companies, technology companies. Oftentimes entrepreneurs will build something nights, weekends, they'll bootstrap it. Product is built, and then we will fund that ramp of a company's sales and marketing organization.
Do you have an average amount that you tend to invest in the company? So for your recent fund, for example, does that represent kind of an average number of investments you're willing to make with that fund, or does it vary?
It does vary, and that gets into there are two answers to that. One is sort of the fund structure, and as a portfolio manager thinking about staging the capital. So there's that answer, and I can talk about that in a second. But the other answer, which is more on the company side, is how early are they? So we will invest as, it's a fairly wide range, something as low as $250K up to $1 million. And obviously the company in which we've invested $1 million is much further along in terms of their revenue ramp. And that's a little bit more of, it was sort of first institutional money in. We've tracked this entrepreneur for a long time. It's Help Scout, Nick Francis, and we think he's fabulous. And that was a little bit more growth capital than sort of early stage money, but it is a Series A, and it is the first institutional money in. So the size of the investment will depend on where a company is in its growth stage. We very much believe in reserving for follow-ons and being able to add more fuel to the fire for a company when it's hitting its benchmarks, and then that dovetails into this portfolio management concept of, look, the way a venture fund makes its money is it has as much money as it can in the winners.
Right.
And that's just the way venture works. And so we think like that as portfolio managers.
I'm fascinated by the fact that here's a group of innovators thinking about innovating themselves.
Right.
So
Right.
talk to me a little bit about what inspired that, what you were seeing in the market that you wanted to innovate from, where you think your competition is kind of moving to, and why you decided to differentiate yourself.
It's a good question because it's a little bit of from the vantage point that I was seeing the venture capital industry sort of change over time and change in very dramatic ways. So, little bit of background. I spent time several years as an institutional limited partner, which means I was investing in venture funds. So you think about where venture funds get their money from. It's from endowments, pension funds, long-term pools of capital, and I, in that role, was able to see what was going on in the venture capital industry over the, this is sort of the 2010 to 2013 phase. Prior to that, I had myself been a venture capitalist, and I lived through the run-up of the internet expansion, and then the tech wreck, the bubble bursting, and watched what was happening in venture capital over, if you look at it from a sort of a 13, 14-year period, there was a huge amount of capital that went into the industry, and anytime that happens, it messes returns, right? There's too much capital chasing too few opportunities, and that happens in any asset class, and then returns come down. I actually did a blog post on this because it's quite fascinating that this denominator effect happened when, during the financial crisis, a lot of money that used to go into venture capital came out because the returns weren't there and institutional LPs were over allocated to venture. And as a result, they stopped committing to venture capital. At the same time, the VC funds that were making it, that were surviving, they were getting larger. So you had this strange contraction and consolidation happening. And I had the benefit of watching this from the perspective of being an LP, and at the same time, I was also an active angel investor, and I was a member of Common Angels, and I could see, over time, this opportunity opening up for seed stage funds, because the VCs were going up market and they were needing to deploy $5 million. If you're managing a $300 or $500 million fund, it's hard to do seed investing.
Right? You have to de-risk a lot more.
Right. Well, and if you can do 10 deals a year as a general partner, I mean, that's an excessive amount. But you need to deploy capital, and it's hard to do seed investing. So this opportunity opened up, and for us, with this fabulous network of innovators themselves, right, founders, entrepreneurs themselves, we saw the opportunity to consolidate capital and make it easier for the entrepreneur to receive one investment check from us, but still have that network of connections behind us. So that's a long answer, but there was both a macro dynamic happening as well as seeing this opportunity of, we can do better. We can serve the entrepreneur better if we change our model and we make the entrepreneur the customer. Sometimes I joke, sometimes investors make the mistake of thinking that they're the customer because as the investor they're writing the check, and so they think that they're the one who matters, and for years I vehemently disagreed, because it's the entrepreneur who creates the value. They are the ones who build the company, and we as investors are privileged to back exceptional entrepreneurs. So why not change our model so that the entrepreneur is at the center, because he and she they're the ones building the company and building the value.
I noticed that in your career you've worked both here and in Silicon Valley. If you had to compare and contrast kind of the innovation market of both coasts,
This is always a loaded
It
question.
is a loaded question, I have to admit,
It is.
and a big one. So if we were to kind of narrow the focus a little bit, in terms of the approach to investing funds, what are some of the key differences that you might see in the approach of the investment community here versus, say, out in California?
Well, it is a different era from, so when I was in the Valley between 92 and 2000, 92 to 02, I think I would give a different answer then that I will give now. The Boston community at large has a little bit more of show me and wanting to see more data, more proof. And this is a massive generalization, so it's really not quite fair. However, there is a tremendous groundswell of change happening in this community where I think where entrepreneurs themselves are getting very active in terms of investing and changing that dynamic of who's investing the capital and getting the next generation of companies started. It's not so much that conservative sort of what you might have thought of 10, 15 years ago of a conservative venture firm. There's as we just talked about, there's innovation within the private capital markets in Boston, and it's coming from individuals, it's coming from micro funds, seed stage funds. I mean, just there's a fabulous new crop of funds who are doing things a little bit differently from what our predecessors did, and that's where there is more risk taking and more getting out of a little bit of a construct of what might have existed before. I mean, I'll tell a funny anecdote. I remember being in the Valley at a closing dinner for an investment, and I made a comment of, being aggressive to get into an investment, and I said the phrase like, well, I'm learning to have sharp elbows or something like that. And the VC turned to me and he said, God, that's such a Boston comment. and I'll never forget it. I mean, this is now probably 20 years ago. But never forgot that oh, okay, let's be self-aware on how we're perceived as an investment community here in Boston.
That's interesting. Now it's a little bit unusual to meet a woman who's so active in the VC community. Although we do see a growing number of women join the ranks of entrepreneurs. What advice would you give for women who might be interested in becoming an angel or joining a VC? What would you suggest they think about if they're thinking about dabbling in the field that you're in?
Well, there are different ways to get closer to the industry, and I do think beginning to invest personally, if you have the wherewithal, is one way to do it. And I encourage. I think there's this perception that women are less risk takers, and which I don't necessarily agree with, but of course that's my perspective because of where you sit is where you stand.
Mm-hmm.
So beginning to and to do that, like there are groups to join. If you've never done individual investing, angel investing, I absolutely recommend getting involved with the various angel groups or investment groups around town. There are several, and then if that's not a path, the entrepreneurship side, learning how startups work is always valuable, and learning the different. I mean, it's a complex process of multiple functions and disciplines coming together, and so being able to really understand sales. Start with marketing, sales, engineering, and finance. Right. So can you train yourself in the multiple disciplines, that give you the insight, and maybe even picking a sector where you become a domain expert in a certain sector. That's where it's getting a lot of investment, and then you can bring that insight and that domain expertise to a venture firm. But it's hard for men to break into the industry, and it's hard for women to break into the industry. It's just there are not that many opportunities to. I mean, they are highly sought after roles to come in at sort of that analyst level or the associate level. But becoming embedded in the entrepreneurial community and being able to, I mean, that's being able to know,
find your niche. It sounds like
find your niche and build your network. So you know who are the up and coming entrepreneurs that are, and then you're the first call that they make when they're going to try to find capital. That's that's a great way to.
Is that part of the reason why you spend a lot of time here at the Cambridge Innovation Center and working with the Venture Cafe?
And coming to, that's why, that's not only spending time here at Venture Cafe, but our office is embedded here at CIC on the 5th floor, and that's the co-working space, which is where a lot of companies start, and we keep our door open so we can be accessible to the community. A lot of entrepreneurs will say, I don't know how to raise capital. So that's something we can solve. We can have we can make ourselves accessible, so entrepreneurs can ask questions, and we don't have such a big fund that we can do a lot of marketing, but we can do that guerrilla tactic of being available, accessible. Exactly. So yes, we love coming here.
That's great. So can you tell me a little bit more about the advice that I saw that you wrote a column at one point for Beta Boston where you gave some advice to entrepreneurs who wanted to make the pitch. And one of your pieces of advice was spend 2 minutes to talk about yourself.
Yes.
So is that still one of your main tips? I mean, is that one of the things that you see that really they tend to fall short on? Or?
Well, it's unwittingly, right? I mean, they're so excited about their product and what they've built and the solution that they want to rush to describe the product. And it is still my main piece of advice of, wait, stop. Tell me more about your background. And the reason for that is investors back people. And so I want to know about you, the person, you, the entrepreneur, and I'm not alone, right? Every investor wants to understand the background of the entrepreneur and the story of why is it that they have become that world-class expert at what they're trying to do, because that then informs and provides the credibility behind why they're going to succeed, why they have a higher chance of succeeding, why they have a higher chance of beating the competition, because they have made themselves uniquely qualified to do whatever it is that they're trying to do. And that's a very important story.
I noticed that when you were giving your tips, you mentioned save the timeline, but then zero in on a couple points on that timeline that were really impactful. Do you find that people find it harder to kind of narrow it down and really kind of show those pivot points, or do you have any particular examples of someone who did it really, really well and that made an impression on you?
Well, yes. I mean, I think it's hard to be succinct. I know I have trouble being succinct, right? I have high energy, and my mouth doesn't work as fast as my brain, and so I know it's hard for everyone. But it is actually telling your story is something that people should practice. It's the elevator pitch. People tend to practice the elevator pitch on the problem and the solution, but not on themselves. How do you boil down your qualifications in 60, 90 seconds? What are the really relevant things to say? And then drill down on the 2 or 3 things that are very specific to the company that you're building. And it's so different for different people and different stages of a company. So at an early stage, right, it may be about being that supreme visionary on product and being able to understand the customer's problem better than the customer even understands the problem. So that 60, 90-second pitch should evolve. At another stage, it may be all about what unparalleled recruiting skills you have, because you're trying to build an organization and you need to attract and hire amazing people who are better than you to build that company.
Mm-hmm.
So at different stages, what your elevator pitch is should indeed change, and being aware of what to emphasize when is I think what I would advise. Yeah.
Maya, thank you so much for joining me here today. I really appreciate
Yeah,
it.
my pleasure. Thank you for having me.
For the Venture Cafe Presents, I'm Christine Dunn.